We're truly a diversified lender, and that covers a range of industries and sectors. Industry diversification is one thing, but one of the most important things that you do for an investor is to lower individual counterparty exposure risk. And so you're wanting to have a well-diversified portfolio by reducing the risk you take to any one individual borrower. Industry diversification is important in the context of understanding some of the structural elements associated with certain industries. There are certain industries that are structurally challenged. Retail, media. There are a lot of industries like that where a range of external forces are impacting the performances of companies in those sectors, and they present a higher risk opportunity to lend. But in terms of diversification in the Australian market, we don't lend to banks. We don't lend to insurance companies and others, so we're not exposed to financial services players. We're exposed to those companies that are acting and operating in the true economy, so industrial companies, mining businesses, property-related transactions, manufacturers. It's a range of industries that we cover, and that gives our investors true diversification across all aspects of the Australian economy. I guess from our side, there are a range of things that are impacting on the Australian economy. We've had the recent impact of the bushfires, for instance, that will notably, slow activity. But equally, when I look at employment numbers and the general trends, there's a range of supporting mechanisms in the Australian economy. And so I guess from our side, we would say that, interest rates are an important aspect, but it's not the key drivers of returns for our investors. Our investors are less worried about duration. They're less worried about interest rate movements, more concerned around credit risk. The real driver for us is around the credit risk in portfolios, because that is probably the risk that would impact an investor's returns the most.